There are certain moments in markets that don't repeat often enough for people to recognize them while they're happening. They don't announce themselves with clarity, and they don't come with instructions. They arrive disguised as excitement, confusion, and noise. What silver just did belongs to that category, not because it went up fast, but because of how rarely it ever goes up that fast. Over the past several decades, silver has spent most of its time frustrating people. Long stretches of sideways movement, sharp rallies that fade, years where nothing happens. That's why moments like this are so deceptive. When the market suddenly compresses an enormous amount of upside into a single month, people instinctively assume it must mean continuation. But historically, that assumption has been both spectacularly rewarding and devastatingly wrong, depending entirely on what came next. The key is understanding that a move like this is not a signal by itself. It's a trigger event. It shifts the market into a different state, one where the next decisions carry outsized consequences. When silver produces a monthly gain that dwarfs almost everything in its modern history, it tells you something has broken out of equilibrium. That equilibrium might have been suppressed valuation, it might have been positioning, it might have been sentiment, or it might have been macro pressure building quietly for years. Whatever the cause, the effect is the same. The market transitions from slow and forgettable to fast and reflexive. Reflexive markets behave very differently. Price no longer responds primarily to fundamentals. It responds to itself. Rising prices attract attention. Attention attracts participation. Participation accelerates price. And because silver is relatively thin compared to other major assets, those feedback loops can intensify quickly. This is where people get confused, because reflexive behavior feels like confirmation. When price keeps rising, the story feels obvious. When it stalls or reverses, the story feels broken. But neither interpretation is correct in isolation. Reflexive phases are unstable by design. They demand resolution, but they don't dictate how that resolution must occur. History gives us two starkly different resolutions that follow the same initial signal. In one case, the market chose speed. Momentum fed on itself. Participation exploded. The move extended beyond what most believed possible. And then, when the structure could no longer support itself, it collapsed. Not gradually, but violently. The decline erased confidence faster than the rally built it. And the psychological damage lasted decades. The price recovered eventually, but the memory of that peak became a ceiling burned into the market's collective mind. In the other case, the market chose time. Instead of accelerating into excess, it absorbed the move through stagnation. Price stopped trending and began drifting. Excitement faded. Capital rotated elsewhere. The absence of reward did the work that volatility usually does. It broke conviction slowly, methodically, without drama. Only after patience had been exhausted did the next major move occur. These two paths feel nothing alike, but they share a common starting point. That's what makes the current moment so uncomfortable. The signal is clear. The outcome is not. Most people respond to this discomfort by forcing a conclusion. They either assume the worst is coming immediately, or they convince themselves that higher prices are guaranteed. Both responses are emotional shortcuts. Markets punish shortcuts. What matters now is recognizing that silver has entered a decision window, not a destination. In decision windows, behavior matters more than prediction. Positioning matters more than opinion. And psychology matters more than intelligence. One of the most dangerous assumptions people make in these environments is that rarity implies inevitability. Because something has happened only a few times before, they assume it must lead to the same result. But rarity doesn't dictate direction. It magnifies consequence. It raises the stakes of being early, late, overconfident, or underprepared. Another trap is mistaking excitement for strength. Strong markets don't need constant enthusiasm. In fact, excess enthusiasm often signals vulnerability. When everyone feels good at the same time, the market has very little room to absorb disappointment. This is where silver's personality matters. Silver has always been an asset that exaggerates outcomes. It rises faster than expected and falls harder than seems reasonable. It rewards patience unevenly and punishes leverage ruthlessly. People who treat it like a normal trend asset usually learn the hard way that it isn't one. What we're seeing now is not silver becoming something new. It's silver behaving exactly as it always has when pushed into extremes. The practical challenge is knowing how to exist inside that reality without becoming part of the statistic. Because the biggest losses in these environments don't come from being wrong about direction. They come from being wrong about timing and exposure. Being right too early feels the same as being wrong if your position can't survive the path. That's why the most important decision right now isn't whether silver goes higher or lower next month. It's whether your approach allows you to remain rational if neither outcome arrives cleanly. If the market chooses speed, it will reward decisiveness and punish hesitation. If it chooses time, it will reward patience and punish impulsiveness. The paradox is that you won't know which environment you're in until after it has already tested you. This is why historical context matters so much. Not because it predicts the future, but because it expands your imagination of what's possible. It reminds you that the market does not owe you symmetry, comfort, or clarity. Silver has reached a point where history says something important is going to happen. That doesn't mean it happens tomorrow. It means the next phase will not be forgettable. And in markets, unforgettable phases are rarely forgiving. What separates people who navigate moments like this well from those who get shaken out isn't intelligence or access to information. It's alignment. Alignment between expectations and reality, between time horizon and position size, between emotional tolerance and market behavior. Rare market conditions expose misalignment quickly, and silver has always been particularly efficient at doing that. One of the reasons these setups are so hard to handle is that they distort feedback. In normal markets, price movement provides regular reinforcement. Gains and losses arrive gradually, allowing people to adjust. In reflexive markets, feedback is compressed. Gains come fast. Losses come faster. The system offers very little time to recalibrate. That compression turns small mistakes into large consequences. This is why many participants misinterpret what being early actually means. Being early is not the same as being wrong, but it can feel identical emotionally. If the market resolves through time instead of price, early conviction gets tested not by losses, but by boredom, doubt, and opportunity cost. Those pressures are quieter than volatility, but they are just as effective at forcing exits. Silver's history is full of examples where the most profitable positions were held through long periods of apparent irrelevance. That's not because those holders were smarter, it's because their exposure was sized in a way that allowed patience. The market didn't reward them immediately, it simply didn't force them out. Contrast that with leverage, which turns uncertainty into a deadline. When you borrow time from the market eventually collects interest. In calm periods, that interest feels manageable. In unstable periods, it becomes unbearable. That's why leverage tends to concentrate losses during exactly the phases where conviction is highest. Another thing worth understanding is that markets rarely transition cleanly from one regime to another. They wobble, they overshoot, they fake people out. If silver is moving from a suppressed environment into a reflexive one, or from a reflexive one into consolidation, the path will not be linear. There will be moves that feel decisive and later prove meaningless, and pauses that feel irrelevant and later prove critical. This is where most commentary fails people. It treats each move as if it must explain everything. Up days become proof, down days become disproof. But markets don't work like that, especially not in moments like this. The signal is not in any single candle. It's in the behavior over time. Behavioral shifts show up subtly. Volatility clusters instead of dissipating. Pullbacks get bought more aggressively or they don't. Rallies stall sooner or they extend further. Volume patterns change. Participation narrows or broadens. None of these are guarantees. They are clues. The mistake is assuming you must act on every clue. Often the smartest response is simply to observe. Let the market reveal whether it wants to exhaust itself quickly or digest itself slowly. Both outcomes will create opportunities. Acting too early can turn opportunity into exposure. Another trap people fall into is confusing narrative with necessity. Just because a story makes sense doesn't mean the market needs to follow it on your timeline. The market is not a teaching tool. It doesn't exist to validate analysis. It exists to allocate capital under constraints. Those constraints are what ultimately decide outcomes. Time is a constraint. Liquidity is a constraint. Risk tolerance is a constraint. When any of those tighten, behavior changes. And when behavior changes en masse, price follows. Silver's rarity in producing moves of this magnitude means most participants have no lived experience with this phase. They don't know what it feels like when a market stops behaving normally. So they default to analogies that don't apply or to emotions that feel familiar but are misplaced. Familiar emotions are dangerous here. Greed looks rational during acceleration. Fear looks rational during drawdowns. Both are situationally understandable and strategically costly if left unchecked. What tends to work better is reframing the problem. Instead of asking, what will silver do next? Ask, what conditions would force me to make a bad decision? Would a sharp rally tempt you to overextend? Would a long consolidation tempt you to abandon a sound position? Would a sudden drawdown cause you to act defensively at the worst moment? Answering those questions honestly is more valuable than any price target. The market doesn't reward certainty in rare regimes. It rewards adaptability, the ability to stay engaged without becoming reactive, the ability to adjust without panicking, the ability to accept that not knowing the outcome does not mean you are unprepared. If silver resolves through excess, history will label this phase dramatic. If it resolves through time, history will label it quiet. But in both cases, the experience for participants will be uncomfortable. That's not a flaw, that's the filter. Markets use discomfort to separate those who are positioned appropriately from those who aren't. They do it without malice and without apology. Understanding that dynamic doesn't eliminate risk, but it does remove surprise. The real takeaway from studying rare historical setups isn't prediction, it's perspective. It reminds you that what feels unprecedented emotionally has often happened before structurally, and that those who benefited were rarely the loudest or the most confident, but the most aligned with the environment they were in. Right now, silver is asking participants to choose how they want to engage with uncertainty. Through urgency or through patience, through leverage or through resilience, through reaction or through preparation. The outcome will reveal itself in time. Your behavior will reveal itself much sooner. And in markets like this, that distinction makes all the difference.